gold has eventually smashed through the $2,800 mark, setting a new all-time high. The shifting U.S. tariff timeline and global countermeasures have been major catalysts for this rally. But what next? What kind of tariff developments should gold traders watch closely? And are there any hidden risks on the horizon? Don't miss this episode of As Good as Gold. Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good as Gold. Gold bulls have actually been on a roll this past week, with prices finally smashing through the $2,800 mark and setting fresh all-time highs. Obviously, the US president's tweaks to tariff policies, both in scope and timing, along with some countermeasures from major economies like China, have been the biggest catalyst for gold surge. And this week, traders will keep a close eye on how the tariff situation unfolds, while Friday's non-farm payrolls report could introduce some volatility to gold prices. So now, if we take a look at the gold against US dollar daily chart, actually since last week's gold video up until yesterday, the yellow metal has posted an impressive maximum gain of over 3.6%. Along the way, resistance has been quite minimal, I would say, allowing prices to breeze past the late October high of $2,790 and the long-awaited $2,800 level, now hovering around $2,840. Nothing screams bull market like new all-time highs, right? If this momentum keeps up, $2,900 is the next big psychological level traders will be watching. While on the flip side, if we see a pullback, the 5-day EMA and $2,790 could offer some support. Well, I mean, sure, some weaker U.S. economic data like December's disappointing job openings and slowing factory orders may have played a role in gold's rally, but we all know that the tariffs are the real game changer here, driving cross-market moves right now. And actually, ever since the White House announced the new tariffs on Canada, Mexico, and China last Saturday, the news flow has been relentless and market reactions have been just as intense. You know, every time actually when I sit down at my desk, I can't help but think, wow, it's a whole new world again. And gold's reaction says it all. Safe haven demand is driving the show. Part of it is hedging against uncertainty over the U.S. president's tariff adjustment. The U.S. Postponed tariffs on Mexico and Canada by 30 days, but the 10% tariff on Chinese imports is still on. And now the president is threatening to slap higher tariffs on the EU while also tightening export controls on semiconductors. I mean, all of this is keeping markets on edge. And for U.S. investors, actually, another big question is, what do these tariffs mean at home? Will they push inflation higher? How much will they eat into corporate profits and economic growth? And how does this all tie into the president's push for lower interest rates and impact the fast rate cut path? So instead of trying to predict the next tariff developments or gauge the U.S. economic outlook, I feel like many traders are just taking the simpler route, buying gold and treasuries as a hedge. But actually, tariffs aren't just about the president's stance. The real wild card is how other countries respond, especially China, and what kind of ripple effect that might have. With the 10% tariffs now kicking in, Beijing has announced retaliatory tariffs of 10 to 15% on certain U.S. imports set to take effect on February 10th. Will tensions escalate further? Well, it's hard to tell at the moment, especially since the two leaders haven't really even spoken about it yet. But looking at how both sides are digging in, this doesn't seem like something either will walk away from unscathed, right? So it's more a matter of when and how bad rather than if things get worse. And once again, the more uncertainty there is, the more attractive gold becomes. So all in all, with shifting tariffs and countermeasures in play, gold has found itself a clear path of least resistance to the upward. That said, there are still quite a couple of risks worth noting. The first one I can think of would be, while global rates market seems to have absorbed the initial tariff shock pretty well. Any major surprise that sparks a fresh wave of equity selling could potentially lead to profit taking in gold, putting some pressure on prices. And the second one could be the latest ISM manufacturing PMI beat expectations, and core PCE inflation remains relatively high, reinforcing the Fed's cautious approach to rate cuts. I know this is not exactly new news, but any data that deviates significantly from expectations could still cause volatility in gold. And speaking of data, today's US ISM Services PMI is on deck, expected to stay at 54.1. If it comes in higher than expected, then it could strengthen the Fed's case for keeping rates on hold, which would be a mild headwind for gold. But the real event to watch is Friday's non-farm payrolls report. Markets are looking for 170,000 new jobs added, down from last month's 256,000, with the unemployment rate steady at 4.1%. And historically, January's jobs number tends to surprise to the upside, and that's the reason I'm watching more closely as well. If it happens, gold could see some short-term pressure, but in the bigger picture, again, tariffs are still the dominant force driving this market. So that's pretty much all for this week. If this video was helpful, don't forget to subscribe, like, and spread the love. If you have any ideas on how the upcoming events might impact gold trading, drop a comment below and let's chat about it. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!